Good morning, hunters, and welcome back to the Daily Hunt from Multibaggers. It's Thursday, November 13th, 2025, and we're here to break down all the market chatter that surfaced from yesterday's deep dive into social media data.
That's right, Ethan. Our AI has been busy sifting through a pretty hefty batch of posts, flagging quite a few different stocks. The sentiment out there is really a mixed bag today. Some companies are seeing a surge of bullish enthusiasm, while others are, raising some serious questions for the KPI-driven investor.
Exactly. We've got a lot to unpack, from established tech players hitting earnings targets to some really speculative plays that are getting a lot of attention. Let's get right into it. First up, let's talk about Cisco Systems, symbol CSCO. Our data shows a lot of positive chatter following their Q1 2026 earnings beat. The news is overwhelmingly positive, with headlines saying they beats Q1 earnings and revenue estimates, and the stock is rising. It looks like their long-standing position is really paying off, translating into strong financial performance and positive market reaction. This is a company we haven't actually discussed before on the podcast, but it's making a strong debut.
Well, Ethan, while the earnings beat is certainly good news, Cisco's current price of $73.96 is very close to its 52-week high of $74.84. Their PE ratio sits at 29.0, which is relatively high for a mature company. It suggests the market is already expecting continued growth. And while the net profit margin and ROE are strong, the debt-to-equity ratio at 63.28 is something to keep an eye on. Strong earnings can mitigate it, sure, but it still warrants monitoring for me.
Fair points, Brooke, but the overall picture, with that robust 7.6% revenue growth and attractive 2.22% dividend yield, makes a compelling case. The market's positive reality check confirms Cisco is performing well. For us, that translates to a clear buy classification today.
Next, SoFi Technologies, symbol SoFi.
SoFi. The social media discussions are overwhelmingly bullish, Brooke. Users are calling it a generational company and talking about riding it from single digits. There's a lot of excitement about its digital-first banking model, strong leadership, and innovative features, like being the first FDIC-insured U.S. national bank to offer crypto trading. Some are even eyeing $50 to $60 targets in the next 12 months. We've rated SoFi quite a few times, a real roller coaster of stay away and buy calls.
Indeed, a roller coaster. And with a PE ratio north of 57 and the stock trading very close to its 52-week high, the market has certainly priced in a lot of that future success. While that 37.8% revenue growth is impressive and the FDIC-insured crypto trading is a differentiator, the high debt-to-equity ratio of 31.99 does indicate higher leverage. For new aggressive positions, one might say hold rather than buy at these elevated levels.
I hear your caution, but the strong community optimism, combined with actual innovative moves and solid growth, suggests there's still fuel in the tank for long-term holders. The news about FDIC-insured crypto trading directly supports their innovative customer-centric strategy. So, based on the AI-generated insights, for us, SoFi is a buy.
All right, let's pivot to Opendoor Technologies, symbol OPEN. We've given this a stay-away rating consistently in the past, and it seems to be generating a lot of buzz again.
Brooke, I know your KPIs are screaming, but the user sentiment around OPN is surprisingly bullish today. People are talking about a turnaround story and even using phrases like OPN opened the door to Valhalla. They're celebrating significant recent price appreciation from its lows, with some users holding from $2 and others targeting $9.6 to $10. There's an analyst upgrade in the news too, which suggests a shift in narrative.
Ethan, turnaround story often translates to high-risk speculation in my book, especially when the underlying financials are this dire. Opendoor has negative revenue growth, negative profit margins, and negative EPS. And let's not forget that staggering debt-to-equity ratio of 203.55. This company is heavily leveraged and unprofitable. While the stock has seen a significant run-up from its 52-week low, a PB ratio of 8.9 for a company losing money means its valuation is based purely on future hope, not current assets or earnings. The beta of 3.592 screams extreme volatility. It's been a consistent stay away for good reason.
You're not wrong about the financials, but the community is feeling very optimistic, you know?
Optimism alone doesn't pay the bills. The numbers simply don't support a strong investment case. For us, Opendoor Technologies remains a stay away.
Okay, let's move on to advanced micro devices, AMD. This is another one that has had a few stay-away ratings from us in the past, and one cautious buy. The social media posts, though limited, show positive sentiment from users celebrating gains, and the news is absolutely glowing, talking about AMD's strong position in AI and data centers, with analysts seeing clear upside and projections of 60% annual data center revenue growth. They're really challenging NVIDIA.
It's true, Ethan. The AI narrative is powerful, and the 35.6% revenue growth is certainly strong. However, AMD's PE ratio is an extremely high 134.84. That's an immense premium, indicating that investors are baking in a monumental amount of future growth. Also, the debt-to-equity ratio is 6.366, which is high for a company of this size, and it's trading very close to its 52-week high. Any stumble in that aggressive growth could lead to a significant correction.
Absolutely. The valuation is aggressive, but the potential in AI is, transformative. If they execute on these targets, that high PE could well be justified over time.
The market is cheering these revenue growth targets, and our AI insights are suggesting potential.
For aggressive investors, there's a case, but for a more balanced perspective, considering the high valuation and debt, this needs to be approached with caution. Agreed. Cautious buy. It is for AMD today.
Next up, Palantir, PLTR.
Now, Palantir has been a polarizing stock, We've had a couple of buy ratings in the past, but also some stay-away calls more recently. Today, the initial social media post claimed PLTR isn't overpriced, pointing to good revenue growth.
But the comments, Ethan, tell a very different story. The overwhelming sentiment is bearish, with users questioning the valuation and calling it trash and overvalued. The PE ratio is an astonishing 438.5, and the price to book is 66.61. One user astutely noted that its market cap implies a guaranteed 7x hike in net income, questioning how the market knows so much about the future. Even an analyst from CICC who upgraded their price target still placed it significantly below the current trading price. The 62.8% revenue growth is good, but it simply doesn't justify these valuation multiples.
It's clear the community has strong opinions, and the valuation certainly makes you pause,
It seems the market is expecting perfection,
Perfection and then some. For Palantir, given the extreme valuation and the prevailing bearish sentiment in the comments, our AI-generated insights classify it as a stay away. Finally, let's talk about Energy Transfer, symbol ET. Now, this one's been a consistent stay away for us in the past. But today, the sentiment is quite bullish in some corners of social media. Users are highlighting its high dividend yield and calling it overlooked. Some even foresee over $1 billion in net income over the next 5 years, driven by increasing pipeline volumes. There's news about a 20-year natural gas firm transportation agreement and potential for AI-driven energy demand.
Ethan, that 8.02% dividend yield is certainly attractive for income investors, and the 20-year natural gas agreement is a strong positive for long-term revenue stability. However, we cannot ignore that debt-to-equity ratio of 135.69. That's exceptionally high, even for a capital-intensive MLP. Plus, they recently reported a Q3 earnings miss and a negative revenue growth of minus 3.9% year over year. The current price is also closer to its 52-week low. While the future prospects are intriguing, current financials show significant challenges.
I get that the past performance is mixed, Brooke, but the community sees it as a deep value play with that low PE of 13.264, and the long-term contracts could fundamentally shift those revenue growth numbers moving forward. It feels like the market hasn't fully appreciated the future potential here,
Potential, yes, but risk is also high with that debt. The news is positive and it could improve future KPIs, but it requires patience and a tolerance for that high leverage.
Taking all that into account and considering the strong long-term catalysts, we'll classify Energy Transfer as a cautious buy today. All right, so after all that market commentary, here's our compiled list of candidates for deeper analysis today. Investigate as buy: Cisco Systems Inc., CSCO, SoFi Technologies Inc., SoFi. Investigate as cautious buy: Advanced Micro Devices AMD, Energy Transfer LP Common Units ET. Investigate as speculative gamble: Opendoor Technologies Inc., OPN.
And that wraps up another episode of the Daily Hunt for Multi-Baggers. Before we go, a quick but crucial reminder. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
That's right. Listeners should conduct their own research or consult a licensed financial advisor before making any investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, everyone. We'll be back tomorrow with more AI-generated insights into the hunt for multi-baggers.